This is the beginning of part 2 of our module on the benefits of hedging, which examines the arguments in favor of and against the hedging of financial risks and the attempts to quantify the benefits of hedging. We remind you that this part 2 contains 2 chapters. Chapter 4, which examines the available literature from the credit rating agencies on the risks and benefits of hedging and the factors considered by the rating agencies in evaluating the quality of a hedging program. And Chapter 5, which examines the available literature from stock market research analysts and academics on those same issues. This very important chapter, Chapter 4, examines the available literature from the credit rating agencies on the risks and benefits of hedging and the factors considered by the rating agencies in evaluating the quality of a hedging program. We recognize that many of our viewers, particularly those located in emerging markets or covering SMEs or middle market companies in the developed world, deal rarely with rated entities. Yet we find the analytical perspective of the credit rating agencies extremely important, partly because it is well-reasoned, transparent, and easy to access, and partly because so many banks and financial institutions in many jurisdictions use some modified version of the agency's ratings criteria to generate internal credit assessments for their corporate clients. Our task in this chapter is easier than elsewhere, since we do not need to debate for long the legitimacy or reasonableness of the viewpoint of the rating agencies. What the rating agencies decide determines how they rate a particular entity, which in turn determines to a large extent the entity's access to the capital markets and its cost of funds. Of course, nothing prevents us from critiquing the judgment of the rating agencies if we have valid grounds to do so, and in some places we will do exactly that from time to time. But whether we are right and the rating agencies are wrong, or vice versa, it is their judgment rather than ours that determines the entity's credit rating, and in substantial part its funding cost in the markets. The news here will surprise you in some ways. The credit rating agencies do not question that financial and commodity exposures are major drivers of creditworthiness, and indeed cite in various parts of their rating methodologies some or all of the following factors as key risk elements in an entity's credit evaluation: energy cost sensitivity, raw material cost sensitivity, risk management, financial market volatility / sensitivity, and interest rate sensitivity. Standard & Poor's in particular, from whom the precise wording of the factors above has been taken, assesses each industry group's exposure to each of these risks along a spectrum that includes the designations high, high/medium, medium, medium/low, and low. The other rating agencies do not approach the matter in an equally methodical manner, but invariably they acknowledge in the text of their methodologies the key relevance of very similar factors, and in some places include them in their quantitative criteria for the determination of the ultimate credit rating, particularly in the case of Moody's, whose methodologies are perhaps the most quantitative. The table appearing now lists for 9 industry groups we selected on the basis of their importance to most economies the S&P designation described above for the 5 risk factors we listed a minute ago. We pause here for a minute to let you review this table. It is one thing, however, to acknowledge any number of factors as key drivers of the ratings determination process, It is quite another to conclude that a credit rating can benefit significantly from a reduction or elimination of exposure to these risks, whether through derivatives or otherwise. With very few, albeit important exceptions, in particular ones involving structured and project finance and other forms of non-recourse arrangements, we have not been able to identify any instances in which a rated entity has received a credit upgrade specifically on account of its proactive hedging of these risks, nor typically a credit downgrade for its failure to do so on any significant scale. In part, this is because neither S&P nor Fitch provides a mapping grid, in contrast to Moody's, for converting an entity's grades on the enumerated risk factors into a final credit rating. But even in the case of Moody's, which provides precisely such a grid for each of its 40 or so industry groups, we find the barest references to risk management generally and hedging specifically in any of them. Indeed, we have identified only one industry group, global airlines, whose rating methodology from Moody's specifically mentions exposure hedging as one of the risk factors directly and explicitly affecting the final credit rating. And even here, this is limited to jet fuel hedging over the next 12 months and does not mention any other financial exposure of any kind. The rating agency recognizes that few airlines hedge their fuel purchases much beyond 1 year, due to cost considerations, illiquidity of hedging instruments, counterparty risk limits, and the fear of finding themselves locked into high prices just before a substantial correction that lasts for several years. Moody's also acknowledges that hedging programs may not be effective under all circumstances, since the airline does not know with certainty the quantity of fuel it is likely to use going forward, and since jet fuel hedging is often implemented via proxies such as crude oil and heating oil due to their greater market depth. Nonetheless, with fuel sometimes representing up to 40% of total airline costs, the agency's view is that, quote-unquote, financially conservative airlines will have a high proportion of their fuel consumption costs hedged. We add two important observations with regard to Moody's viewpoint on jet fuel hedging, which apply generally to any attempt to quantify the benefits of hedging for any type of exposure. One, the rating agency does not specify clearly what it considers an adequate hedge for purposes of this criterion, mentioning briefly for jet fuel hedging options, collars, and futures without further detail. No distinction thus is made between call options or caps with strikes close to the current spot and ones with strikes much farther away. The latter, of course, being much cheaper, but offering protection of a poorer quality. Observation 2. The rating agency says nothing about how it would view various kinds of structured derivatives, but presumably it would frown upon hedges, common in certain regions and industries, that offer some protection in most scenarios while exposing the user to potentially large losses in a small subset of the remaining scenarios. In our module on airline industry analysis, we sought to quantify the credit rating upgrade that an airline might earn from Moody's if it adopted a policy of hedging 100% of its jet fuel purchases for the next 12 months. The particular carrier we evaluated in that module, Royal Jordanian, was found to earn a rating of BA3 while it hedged none of its jet fuel purchases, which rose to BA1 under a 100% hedging scenario. For entities as capital intensive and hence highly leveraged as airlines, the interest savings from such an upgrade would be substantial, of course. But, unlike our case in Chapter 1, with the US bank hedging its exposure to the euro, we would not be able to argue in this instance that jet fuel hedging costs the airline just a few basis points of dealer profits. Nor would it continue to make sense to ignore the substantial collateral requirements a dealer invariably demands for mitigating counterparty risk on derivatives, especially those involving energy products, or the comparably large utilization of credit lines that such practices generate on any uncollateralized portion. You can find the details of the Royal Jordanian discussion and the rating simulation in Chapter 4 of our module on airline industry analysis. Very surprisingly, we find almost no other discussion of the benefits of derivatives in the literature from Moody's, although we do find some discussion of their risks in a number of places. It is to S&P and Fitch that we turn to shed partial light on the potential benefits these instruments might generate for their users. Beginning with S&P, we recommend highly a research report entitled U.S. Oil and Gas Sector Makes Extensive Use of Commodity Derivatives, dated June 14, 2006, a link to which you can find in the course outline available to you by clicking the icon at the bottom left underneath this video. We summarize the key findings of this document next, but advise you very strongly to read it cover to cover. As should be apparent from the report's title, S&P acknowledges the very extensive use of commodity derivatives by oil and gas companies in the US, and it reproduces in Table 2 of that document, for 26 companies in total, selective disclosure from their SEC filings, confirming the use of forwards, futures, swaps, options, fixed price delivery contracts, basis swaps, caps, floors, and collars to hedge the risk of commodity prices, but also in many cases in connection with FX and interest rate hedging. A table is also provided a little later that plots for each company covered in the report the hedged percentage of next year's production against the company's credit rating. We reproduce this table here and point out, as does S&P, that the higher rated entities appear to have hedged very little, but that starting with the BBB- rating category and below, it becomes commonplace to hedge from 20% to 80% of next year's production, albeit with no discernible correlation between the specific percentage and the credit rating. The most likely explanation of this is quite simply that the very solid credits do not need to worry about hedging as much as the weaker ones. The rating agency also acknowledges that the quote, oil industry is cyclical and commodity prices are highly volatile, which is a major reason companies use commodity derivatives, both to hedge specific risks and at times for profit-making purposes, also referred to as trading or speculating, unquote. It also confirms that the exposure to commodity price movements is significant for oil and gas producers and refining and marketing operations, and that locking in selling prices for crude oil and natural gas may affect credit risk evaluations in this cyclical, highly volatile commodity business. A subsequent paragraph in the document is promisingly titled Derivatives Fix Selling Prices and Reduce Volatility, and even identifies specifically a, quote, desire to lock in economics of oil and gas business or reserve acquisitions on cash flows for future spending programs, especially when acquisition multiples in the sector are at historically high levels, unquote. In effect, the situation of the gold mine acquisition in our case study in Chapter 2. Right in the next paragraph, entitled Derivatives Help Lock in Future Cash Flows, S&P mentions that, quote, in connection with a $4 billion stock repurchase program, Kerr-McGee Corp expanded its hedging program in 2005 to approximately 75% and 80%, respectively, of 2006 oil and gas production, and approximately 50% of expected 2007 U.S. production, unquote. A situation that is conceptually very similar to our case study with the bank in Chapter 1, since the purpose of the hedge, in the case of Kerr-McGee, just as it was for our bank, is to reduce shareholders' equity and increase leverage without an undue increase in its risk profile, presumably with a view to the enhancement of return on equity. Just a page later comes the key paragraph, the effect of commodity hedges on ratings, which reaffirms that, quote, commodity price volatility represents one of the chief risks considered in our analysis of oil and gas producers. Also that a period of low commodity prices can materially affect a company's ability to meet its debt service obligations. And finally, that the last wave of defaults to impact the sector occurred following the oil and gas price collapse of 98-99, and there have been few defaults since that time. Inevitably, this leads to the critical question posed next by S&P. Quote, with commodity prices representing such a prominent risk in the sector, how does Standard & Poor's view the use of hedges to mitigate price risks? And just when you thought it was safe to go into the water, along comes the apparent whammy. While perhaps counterintuitive, the degree to which a company hedges does not materially affect its corporate credit rating in most cases. Corporate credit ratings reflect the company's long-term ability to meet debt service requirements. In most cases, hedges only cover 1 to 2 years of anticipated production, and therefore do not mitigate cash flow volatility risks over the longer term. If this comes as a shock to end users or salespeople watching this video, some partial consolation is offered next, in a paragraph we quote in its entirety, given its importance and the hope it offers for the continued justification of hedging strategies as tools for improving the user's credit rating, despite the sting at the very end of the paragraph that again evidences the agency's doubts on the matter. Quote, that said, commodity price hedging may positively affect ratings in 2 ways. Mitigating near-term cash flow volatility risk. Standard & Poor's can more confidently project a company's near-term cash flows when a significant portion of anticipated production is hedged. Speculative-grade companies, particularly those rated B or lower, have a significant degree of liquidity risk, and these companies' ratings may benefit from hedging. Maintaining a conservative financial policy. A consistent policy of hedging anticipated production may reflect a more conservative financial policy. However, surprisingly few companies, in our opinion, have demonstrated a consistent policy of hedging commodity price risk through the cycle. Merely having hedges in place does not necessarily indicate a conservative financial policy. Some companies attempt to time the market and will actively enter and exit hedges to try to maximize shareholder value. Unquote. Fortunately, S&P goes on to recognize immediately after this paragraph that it does incorporate hedges when forecasting an E&P company's cash flow. The rating agency stipulates a base case set of pricing assumptions to project cash flows and key credit statistics. the results of which play a key role in determining credit ratings. To the extent a company has hedges in place that are above these pricing assumptions, S&P will give benefit for the hedges. So where a company does implement a commodity hedge, quote, beyond the next year or two, unquote, S&P skepticism as to the value of hedges appears to weaken substantially. For your amusement, we show below the base case assumptions stipulated by S&P in the document, asking you to remember that the date of the document is June 14, 2006, and that the assumptions are stated to be as of May 9, 2006. The next remark from S&P is instructive for what it clarifies and troublesome for what it omits. S&P asserts that if a company uses collars, which are combinations of equal notional amounts of call and put options at different exercise prices that create a minimum selling price, the floor, and a maximum selling price, the ceiling, then the floor price and not the midpoint or the ceiling price is used. A statement whose logic is impeccable. What S&P does not address, as with Moody's, is how the rating agency would react to structured derivatives that offer protection under the great majority of cases, but expose the company to large losses under a narrow set of circumstances. This would be the case, for example, if at the time when the oil curve is flat at $100 per barrel, to keep matters simple, a producer purchases floors on his estimated 12-month production at a strike of 95 and sells caps on 10 times the same notional, but at a strike of $150, say. A strategy whose essence has been used all too frequently in the oil and gas industry and several others. S&P addresses next the case of positions that have gone deep in the money against the end user in a rising market, as would affect any producer that, in the past, sold production forward at a price substantially lower than today's, generating a large mark-to-market liability on his balance sheet and, depending on certain factors, a loss in his income statement. The first remark is encouraging from a ratings perspective. As a general statement, such derivatives liabilities are not considered debt when calculating financial leverage ratios, since the rating agency rates to relatively conservative price assumptions, and much of the hedging losses would dissipate in a lower price environment. To clarify, assume that in 2005, when the base case projections we showed earlier were in place, a company informs S&P that it had previously sold forward its Brent-type crude at the price of $50 per barrel, and that these forward contracts remain in place until 2009. Assume also that the spot and forward curve today is flat at $60, and that annual crude sales for this company are projected to reach 1 million barrels. You will note that the projected sales for 2006 are underwater by $10 a barrel, meaning that for accounting purposes the one-year forward contract has become a balance sheet liability in an amount equal to the present value of $10 million. The same is true of the forward contract for 2007, 8, and 9. So the aggregate balance sheet liability recognized by the company is for an amount equal to the present value of $40 million, which we stipulate to be $35 million, taking into account the discounting to present value. Nonetheless, S&P would not add this $35 million amount into debt when calculating the company's financial ratios. This is because, in its base case scenario, S&P assumes that going forward prices will revert to the levels indicated in the table above, namely $58 for 2006, $48 for 2007, $38.50 for 2008, and $29 for 2009. Only the first contract would remain a liability under these assumptions, the one for 2006. And even this contract will represent for the company an opportunity cost on its settlement date of a mere $8 million, or 20% of the original figure of $40 million. In fact, the subsequent forwards will enhance the company cash flows under the base case assumptions. So the hedges in aggregate are still beneficial from S&P's credit perspective. Now assume the company panics at the continued rise in crude prices and decides to unwind its hedges at their mark-to-market value of $35 million. Assume further that the company does not have the cash to unwind these transactions and resorts instead to newly borrowed funds. The size of its balance sheet will not change, since the derivatives liability of $35 million is merely replaced by a bond or loan in the same principal amount. Yet, from a ratings perspective, the company has crystallized the negative mark-to-market and turned it into a cash loss, which it has settled with the proceeds of its new debt. Unlike the previous derivatives liability, which would decrease if prices move lower, the size of this new debt will remain unchanged if and when prices decline. So the debt ratios for the company have clearly worsened, although S&P recognizes they have not truly worsened by the entire $35 million amount. In addition, S&P views the transaction as qualitatively negative from a credit perspective, reasoning that the contract termination represents a departure from the company's previously more conservative approach to the hedging of commodity price risk. S&P turns next to contract triggers and collateral matters and finds additional cause for concern. Specifically, the agency worries about liquidity triggers in derivative contracts, i.e., clauses that require the end user to post additional margin if either the value of the existing margin diminishes or the mark-to-market of the contract continues to move in a manner adverse to the company, or if the credit rating of the company declines. With commodity prices so volatile, the obligation to post collateral may substantially reduce company liquidity and may be called upon in an unexpected manner in terms of both timing and amounts. S&P mentions the case of Hess, which was obligated to post letters of credit in excess of $3 billion for hedge collateral in 2005. Cross-default or cross-acceleration provisions allowing the derivative counterparties to benefit from a claim on company assets in the event of default are also of concern to S&P. The last concern S&P raises in this report relates to what it calls event risk, the type of risk that became manifest during the hurricane season of 2005. With many Gulf operators suffering a dramatic decline in production levels after the hurricanes, cash flows shrank and hedged operators were left in a net short commodity position, having sold forward output they no longer expected to produce. In some cases, the companies had to make good on their hedges, which of course had moved in a steeply adverse direction in view of the spike in prices, exacerbating dramatically the company's worsening liquidity. In addition, any favorable hedge accounting the companies had achieved on the basis that the future sales of the hedged product were probable had to be discontinued when these sales became unlikely, causing the related deferred losses to be recognized in the income statement immediately. Illustratively, a significant portion of Newfield Exploration's Gulf of Mexico production was shut in because of the hurricanes, forcing the company to discontinue hedge accounting on a portion of its oil and gas cash flow hedges and to record $238 million in commodity derivative expenses in the third quarter of 2005. In a slightly earlier research report from S&P, increasing derivative use by corporate issuers calls for closer scrutiny, dated November 9, 2005, the rating agency provides a very comprehensive list of the key analytical considerations it applies to companies' derivatives practices. Many of these are self-explanatory, so will elicit no comment from us, but where necessary, we will add in a word or two via footnotes. Under Business and Market Environment, S&P lists the following: general industry characteristics. S&P notes here that its objective is to identify how the fundamental risk exposures of an issuer and its relative market position influence management strategy with respect to risk management, with peer analysis playing a critical role. Level of business and financial risk exposures related to interest rates, foreign currencies, commodities, and credit risk, as well as corresponding management strategies for managing such exposures. Next, overall impact of derivatives on the issuer's business, including types of derivatives used and notional amounts. Next, existence of natural hedges, e.g. foreign currency revenue versus costs and borrowings, pricing elasticity, etc. Next, the extent of derivatives used for risk management and hedging purposes. The extent of derivatives used for speculative or trading purposes. Consistency of derivatives use with business strategies, risk profiles, and peers, including the existence of recent directional changes. This item is reminiscent of S&P's reaction to the unwind of Kerr-McGee's forward sales, which was perceived as evidence of a less conservative financial policy. Next, complexity of derivatives used. Plain vanilla derivatives or highly structured or leveraged derivatives. Recall here our earlier comment that S&P does not specify how it would react to derivatives of this kind. This report provides no further information on the subject. Next, use of derivatives embedded in non-derivative contracts. Existence of significant swings in notional amounts of derivatives used in hedging, without corresponding changes in the underlying risks being hedged. And finally, the sensitivity of the fair value of derivatives to plausible changes in underlying variables. Under liquidity, S&P lists the following: the existence of trigger, collateral, or early termination provisions, the extent of counterparty risks or concentrations, and any unusual security rights provided to counterparties, the liquidity profile and the potential impact of derivatives on covenants and cross-default provisions, and finally, whether potential volatility as indicated by value at risk or other sensitivity analysis measures could cause liquidity concerns. Under Controls and Risk Management, S&P lists the following: comprehensiveness of risk management policies and procedures, whether risk management is outsourced or in-house, centralized or decentralized, and an indication of size and experience of the risk function. Next, tone at the top and extent of independent oversight related to derivative use and risk management policy. Next, management practices for approval process and monitoring risk, including counterparty risks, collateral requirements, risk limits, and any embedded derivatives. Next, market risk metrics used to monitor and manage risk and significant assumptions, e.g. value at risk. And finally, the track record of risk management and any history of unexplained shifts in derivative and hedging strategy or the presence of large unexpected losses. And lastly, under financial statements, S&P lists the following: impact of derivatives positions, including embedded derivatives, on the financial statements, including balance sheet and the income and cash flow statements. S&P states here that where these are analytically significant and material, it seeks to neutralize accounting effects for credit ratio and comparative purposes, and evaluates the extent to which key financial measures and ratio calculations based on reported amounts are influenced by derivative accounting treatment. At times, adjustments are made where the analyst determines this makes the resulting measures and ratios more meaningful in the assessment of creditworthiness, and the adjustments are practical. Next, sensitivity amounts are reflected in the financial statements relative to significant estimates made and the use of aggressive assumptions to determine the fair value of derivatives. We believe this refers to how accurately a company is able to estimate the potential changes in value of its risk positions. Next, the extent that derivative gains and losses impact ratios used by S&P. The significance of gains and losses associated with hedge ineffectiveness or of unexplained, unanticipated, or volatile financial results arising from derivatives. Next, the mismatching of reported income or expense and underlying cash flows arising from derivative use. Next, derivative results that are inconsistent with industry trends. And next, extent to which the hedging practices are influenced by accounting rather than economic considerations. This is S&P's way of encouraging users to hedge risk based on the underlying economics and to worry less about the ability to achieve hedge accounting, a point we made as well at the end of Chapter 3. And finally, the clarity of financial statement disclosures. We conclude this Chapter 4 with a quick examination of the Fitch perspective on derivatives use. A simple review of the titles of recent Fitch publications on our present topic confirms the rating agency's awareness of the critical significance of financial and commodity exposures to the creditworthiness of many issuers. Since May 2010, Fitch has released at least 3 special reports that focus on the credit and similar implications of large financial and commodity exposures in highly volatile markets. These are the following, links to which are provided in the outline you can access by clicking on the icon at the bottom left below this video. $150 per barrel crude oil, credit implications across the corporate sector, dated May 3, 2010, and hereinafter Document 1. Countering the Euro shock, the dollar's appreciation and U.S. corporate credit risks, dated July 14, 2010, Document 2. And Commodity Inflation in a Multi-Speed World, Corporate Winners and Losers, dated February 22, 2011, hereinafter Document 3. None of these reports, however, addresses the specific question of the extent to which derivative hedging in and of itself can improve creditworthiness or can bring about an explicit upgrade from the rating agency. Like S&P, and unlike Moody's, Fitch does not provide quantitative grids which permit estimation of an issuer's credit rating from a scoring of designated risk factors. What they do provide in many places is a detailed description of the use of derivatives by leading corporates who are seeking to mitigate some of these exposures, the lessons learned from past misuse of some of these instruments, and the difficulties faced by issuers who are unable to utilize derivatives to hedge major exposures, particularly commodity exposures, for any reason. All of which appear to confirm the rating agency's belief in the value of hedging strategies to mitigate cost pressures. For example, in its commentary in Document 1 on airlines' exposures to soaring jet fuel prices, Fitch states that given the difficulties associated with near-term schedule and crew changes, U.S. airlines remain focused on the need for close-in hedge protection, with the hedged portion of expected consumption generally trailing off to minimal levels 3 or 4 quarters out. Shortly thereafter, however, Fitch explains how a number of U.S. airlines that had entered into collars in the first half of 2010 landed into a liquidity squeeze in the third quarter when prices began to decrease and cash collateral flowed rapidly in the direction of counterparties as contracts were marked to market. In consequence of what Fitch describes as the hedging debacle of 2008, Fitch explains that many carriers started shying away from jet fuel hedging or reducing the size of their hedge book, exposing themselves to substantial vulnerability to a rapid spike in price. U.S. Airways, for example, would have faced annualized fuel cost increases of more than $2 billion in a repeat of the scenario of $150 per barrel crude oil. In an effort to limit the collateral-related liquidity pressures in a highly volatile energy market, airlines began steering away from collar strategies and began favoring the simple use of calls on crude oil and jet fuel. Document 2 from Fitch similarly describes, for a whole series of industries, the severe pressures they are encountering on account of the price spikes in oil/jet fuel, natural gas, cotton, corn, wheat and soybean, aluminum, steel and rubber, and beef and chicken. The industries analyzed are the following: airlines, ethanol, protein processors, packaged foods, retailers and department stores, restaurants, beverages, and automotive suppliers. Numerous remarks throughout the report testify to the very real difficulties increases in input costs are causing for issuers in these industries, to the benefits reaped from having instituted hedging strategies before prices began to soar, and to the dilemmas faced by industries for whom hedging tools are illiquid, expensive, or even completely unavailable. Most affected are those industries who have already engaged in an extensive round of cost-cutting a few years ago and therefore have little fat left to trim, and those for whom product demand is elastic and who therefore have little capacity to pass on their rising costs to their customers or franchisees. When discussing the airline sector, for example, Fitch observes that, quote, under a scenario in which crude oil rises from current levels to approximately $110 per barrel in the second half of the year, hedging programs would provide increased levels of cash flow protection, but clearly not enough to eliminate severe margin pressure in the absence of fare hikes. And when Fitch turns to protein processors, it asserts even more powerfully its conviction that large, unhedged commodity exposures can bring ruin to an issuer. Quote, In 2008, record corn prices, along with product oversupply and declining product pricing, resulted in widespread losses throughout the protein industry. The impact was devastating for highly leveraged single product firms like Pilgrim's Pride, which filed for Chapter 11 bankruptcy protection in December 2008. The more troubling aspect of the report is the frequency of references to hedging practices that backfired, in some cases even contributing in no small way to the user's bankruptcy, according to Fitch. We quote two of the passages next in their original form, since they are clear and well crafted. Regarding the ethanol industry, Fitch states that poorly timed hedges were a major factor in the wave of ethanol producer bankruptcies seen over the 2008 to 2009 timeframe, including the industry's largest bankruptcy filing, Verasun Energy Corp., which was driven by a hedging program that locked in corn feedstock costs at the height of the agriculture boom prior to the collapse in the selling price of ethanol. And with regard to protein processors, we learned that, quote, ineffective hedging added to losses incurred by chicken producers in 2008. Pilgrim's, Tyson, and Smithfield all realized losses in excess of $100 million due to mistimed hedges. Most of these companies appear to have learned from their mistakes and instituted changes to their risk management practices. While industry disclosure on hedging practices remains murky, both Tyson and Smithfield have shortened the duration of their derivative contracts, while Tyson has increased its use of lower risk options contracts and is engaging in fewer fixed price and shorter term agreements with customers. These strategies reduce the risk that the company will lock in unfavorable long-term economics. However, as with any hedging strategy, they are a double-edged sword, as a shorter hedge profile would offer less protection in the event of a sustained run-up in input costs. We would question whether a company that hedges against a rise in prices has a lesson to learn if those prices begin to fall after the company implements the hedge. The purpose of the hedge should be to reduce or eliminate the exposure to a potential increase in prices and to lock in a margin that the company finds adequate. That this margin could in fact become larger when prices decline, but for the hedge, should not be regarded as a failure of the hedging strategy. Indeed, it should be viewed at inception as a scenario with a 50% probability, whose adverse consequences to the company are within its risk tolerance. However, there is no escaping the reality that if most peers have remained unhedged, or are less extensively hedged, when the price decline occurs, our company will find itself in a difficult position competitively. Our conclusion from this review of the Fitch literature is that the rating agency is well aware of the critical importance of volatile cost pressures on companies' business model, and views hedging as one of the key tools for protecting against the consequences, along with cost cutting and the ability to pass on a portion of these costs to the final customer. Like the other rating agencies, however, Fitch to date has not articulated a completely coherent philosophy regarding the optimal use of hedging tools, nor any reliable guide as to the benefits in credit rating terms a company can anticipate if it implements an appropriate hedging strategy. This concludes this chapter 4.